Good evening, good evening, everybody. Sorry for the delay. This is your host, Eugene Bias, coming to you live on Let's Learn About Money. For those of you on Facebook um, and any other social media, Twitter, Timber, to name a few, welcome, welcome, welcome. Tonight we have a very vast topic that we're going to be talking about. We're going to be getting into in great depth. Um, and I would like everyone to pay keen attention, get out your pen and papers to make notes because it's going to be very interesting. We're moving from proper protection to emergency funding in the seven milestones of a financial DNA discovery. So, without further ado, I would like to introduce everyone to the company, EHB Services LLC. We're a financial services company which provide a number of services. After this message, we'll be right back.
EHB Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or boat. Call Gene at 855-411-0424. You can also follow him on Facebook, Twitter, and LinkedIn.
Great, great, great. At this time, I will do a quick recap, continue from where we left off last week, and move forward as to where we need to be in our segments coming forward. Okay. I'd like everyone to know that we are on target to building what I would call a legacy to leave for our family, our loved ones, in the case of a loss. And I'm proud to say that a lot of people have taken me up on the offer, have challenged my abilities, my skills, to learn about providing that legacy for their family. So we spoke about term insurance, we spoke about whole life insurance, but um, there's other policies out there that we didn't touch on. Okay? And one of the policies is a type of policy that a lot of people of color does not take out, even though they are deemed business people. And that's a key person policy. And a key person policy is a very important policy to have when you own a business. Because there are two fronts a key person policy can work, will work, and do work. Okay? So, I'm catering to everyone. All the entrepreneurs, we will have some sort of shortcoming. We must die. I heard a pastor said Saturday, if you're born of a woman, you must die. It's in the Bible. But not everyone dies, they also get sick. Depending on the type of business, okay, they can be catastrophic, critical illnesses, chronic illnesses that can cause you to be disabled and not able to perform your regular duties. So this evening, I would like to really get into where we left off on these policies and where we need to be, or where I would like us to be. Okay? A key policy is an insurance that is, it's a life insurance policy that is purchased by a company. Okay? By a company. The company pays for it. Okay? It's a tax deductible by the company because it becomes a business expense. That policy give the owner of the company, the top executive, and other individuals who are considered critical to the business. So I'll give you an example. What if you have a restaurant? You own the restaurant, and you have one major cook in that restaurant, and that major cook falls ill. What happens to the restaurant? Are you able to call an agency and get an emergency cook to come and support your business? Or do you have to close the door for that day or that week that that person is out? Okay? That's just an example. Okay? It's a key person policy for key men and key women in a business. Okay? The business life is like any other life, your regular life. It's no different. Okay? And tonight we'll talk about the big things: chronic illness, critical illness, terminal illness, okay, and living benefits that is available to key parties, key persons in a business. Key person insurance is a life insurance policy that the company buys, not you the individual. The company buys, okay, for the top executives of the company and any critical individual to the operation of the business. Okay? Such insurance is needed that if that person dies, it would be devastating for the future of the company. Devastating for the future of the company. You need to understand that you are a visionary. You have the vision to own the company. You put or hire certain people to do certain key functions in the business. Those people that are working for you, bless their heart, they may provide some duties that you as a business owner are not able to do, or you're not proficient at doing, or you simply choose not to do it. But being a visionary, and I'm sure everyone or most people know what a visionary is. Okay? You have vision, you have focus, you have direction, you know how to lead the flock. Okay? And how do you provide a service to everyone for them to understand that they are key in the business, but they are not your only saving grace in the business? If that person become disabled or die, do your vision die with that person? Okay? Do your business die with that person? Okay? As a visionary, you want to be able to have that stability in your business, that safety net that you can go out and hire someone at reasonable market rate and pay them to do the job. Okay? For small businesses, the key person might be the owner or the founder of the business. The key person might be the owner or the founder of the business. So it would be you, the visionary. Okay? You may not take a salary from the business in the beginning. We all know as business owners what we do. We invest and we put our all into the business. The question is, We drive every day. We take the train. We take public transportation. We take the bus. Something happens. Okay? What happens to our business? Can our business be sustained without our presence being there? And that is very important for us to know and control. The company pays the insurance premium. It's a tax write-off. Equally so, the policy beneficiary supposed to be for an individual. It can be for the company, but it should be for an individual because it's in the loss of an individual that you're replacing into the business. Key policy insurance offers a financial cushion if there's a sudden loss of a certain individual, or it would profoundly negatively affect the company operation. If the death of the person would affect the business in a negative manner, what happens? The death benefit of an essential policy is now used to find a new person to implement other strategies to save and avoid a shutdown of that business. Now I ask myself and I challenge you to tell me how many people in business have a key policy. You are the head, you are the chief, you are the main person that makes this business operate and run. And something happens to you and the business goes belly up. Yeah? It's very simple. It's very simple. There's only two elements to consider. If the key person is usually the owner, the founder, or perhaps a key employee or two in the business, the main qualifying point is whether the person absent would cause a major financial harm to the business. Major financial harm to the business or the company. If this is the case, the key policy will be definitely worth having. Definitely worth having. Okay? And if you give me a call on 1-855-411-0424, I can put one of those policies in place for you. Okay? To cover your business, to cover your assets. Okay? Which does not take away from your family, your regular life insurance, your personal life insurance. Okay? In addition to life insurance, a key person insurance also is available for disability coverage. Now, if you're not able to work, you become incapacitated from that business, but you're still alive. That policy provides a cushion, a safe haven for you to be able to take care of your family, to run the business at the same time, as you hire, advise, teach, train the new person that's taking over from you and still pay you a salary. Okay? As the key person or owner of the company. Okay? So these are things that we don't take into consideration. We think about death. Insurance policies are no longer about death. Okay? It's no longer about death. Okay? Insurance policy cover the big things. Heart attack, stroke, cancer, loss of limbs, blindness from diabetes. Okay? All those things are critical illnesses. It's not death. they do have a living benefit element to it that can work for you, bring in money. Okay? So you're not out. The money can be used from a key person policy for recruiting, for hiring, for training of a sick or deceased person. If the company don't believe it can continue to operate, it can use the money to pay off debt, distribute money to investors, provide severance pay to their employees, and close down the business in an orderly fashion. So if you're a person that like to do things in order, have your affairs taken care of, this is a good policy to have in order to do so, to take care of you in case there's a loss. When you pass from life to eternity, or you get ill. What if you become critically ill? You're unable to bathe. You become incontinent. You can't dress yourself. You're using a transfer board or a hoist. Does that mean life is over? You have two policies: your personal policy that provide up to $1.5 million in coverage, and you have your key person policy for those of you who have a business. Okay? It's very important to have and to put these things in place if you want to be or feel responsible. Insurance protects your profit. A key person insurance protects your profit. So some people say, well, how does it protect my profit? Well, it's very simple. By having a key person policy, offsetting lost income from lost sales or losses result from a delay or cancellation of any business project that the key person is involved in, is categorized as a loss that is covered by a key person policy. So I don't know if you guys are hearing me. If something happens in the business, this policy will protect you. It's only designed to pay out when something happens in the business to the key person. Okay? The insurance is designed to protect shareholders and partnerships. We're seeing less shareholders and partnership in the community. We're seeing a lot of solo business owners. Typically, this enables the surviving shareholders or partners to purchase the financial interests of the deceased person. You are letting go by giving your family the financial stability to know that you own a company. And now that you die, your interest is secured because you put these safe havens in place while you were alive and kicking. And I think that's marvelous. Okay? So the shareholders and your partners in the business don't have to get into uncomfortable, distasteful conversations with family members regarding your share. Okay? Moreover, insurance for anyone involved in guaranteeing business loans. So if you personally guarantee a loan for your business, like the SBA was giving up EIDL loans over the pandemic, that is now delayed for 30 months. instead of being repaid in 24 months? What if within that 30 months you became disabled? That loan is guaranteed by the business. It's guaranteed by you, the business owner. How is that money going to be paid if you become disabled? What about a cash advance? What about a line of credit? How is it going to be paid? Those banking facilities are guaranteed by you, the key person for the business. How are those going to be covered? The value of the insurance company is arranged to the equal value of the guarantee. Of equal value of the guarantee. And my friends, I will tell you, it's very, very reasonable. Very, very reasonable. I ran some numbers, I look at some policies, and I will tell you, okay, one major insurer, for example, would currently charge $107 a month for $500,000 in a key person policy. $500,000 for $107 on a 20-year term insurance, 20 years, term insurance on a healthy 50-year-old male. Healthy 50-year-old male. That means he don't have any chronic, critical, or terminal illnesses. Raising the coverage to $1 million would bring your monthly cost to $190,000. Pennies for a business owner. $1 million costing you $190. $1 million costing a business owner $190. So if you cannot invest $190 to get $1 million, should you become disabled or die, then you're not ready to be in business. Now I have something to share. I have something to share. And what I have to share is very important. You can have an IRA account that can provide access to investments such as stocks, options, cryptocurrency, with potential tax advantages. Potential tax advantages. Now you listen to me carefully, guys. Here is where we fall short. Those investments are generally in a variable market, variable investment. No guarantees on your money. No guarantees on your money. When you die, you don't know if the market is going to be up, it's going to be down, or it's going to be just in the middle, neither up nor down. We have a war going on today. Inflation is up. Everything is affected by that war. Are you prepared today to take risk or secure your business? Hear the words. Are you prepared today to take risk or secure your business? If you decide to take risk, God bless you. And God bless everyone that wants to take risk. If you're looking to have a guaranteed security, give me a call at 855 411 0424, because I can put you into a plan that will work for you, not because you are a business owner or entrepreneur and a visionary. You're indispensable. We're all susceptible to death. We all has the liability when we step outside, we can have an accident or something can go wrong. So, we have spoken about whole life insurance and the different types of whole life insurance. Okay? In the financial literacy, the financial education, we have talked about proper protection against your income. Proper protection against your income. So, I would like to close out this side of it, the proper protection side of it, because I want to move into a very technical element, and it's debt management. I want us to move and look at debt management, having emergency funds. So, with this being said, I would, as I prepare for our new segment, I will take a few questions, if there's any, that would be helpful, advantageous to this. The first thing that I'd like to do is thank our Facebook viewers who are currently logged in. Have questions, and I'm going to answer the first one. Yes. The first one is asking about how many people can a key person policy cover. A key person policy cover all of your executive and your shareholders and your partners. So all who have a stake in the business, not just an employee, but people that has a stake in the business. It do cover key employees. For example, if you are a, I don't know, Caribbean cuisine, and you have a cook who provide a special entree, or he takes care of all your entrees in the kitchen, he or she may fall ill, become disabled. You don't know to provide it. You're not available to do the job. But the job has to get done. What do? You need that person to do it. So, you have to hire someone to go and do it. Where is the money coming from without burdening the company with that additional expense to get that person to do that for you? So you have to look at structure, your business structure, to see what your capital expenditure would allow and who are your key persons. Okay? The next question I have from Facebook is someone is asking, how many, 1 second, how many years? Okay. A key person policy can be a term policy or a permanent policy, a whole life policy or a term policy. Remember this, guys. A term policy has a fixed time. So if the business is only going to be operating for 20 years, or you feel something is going to happen to you or could happen to you for 20 years or 30 years, you take it out for that term. But if you're like me and you don't know, would like to know, not sure, and you want to have longevity in the business, by planning ahead, you can have quotes from $100,000 to $1 million. Okay? I just give you an example of two. So yes, you can have a permanent policy. You're not only subjected to a term policy. And for those of you who've been joining the call on a regular basis, you would know that term policies is not my cup of tea. Yeah, it's not my cup of tea. I like whole life policies because I like people to plan into the future. Even though a term policy is cheaper, I prefer a whole life policy. Okay? There's life guides that you can look at. Okay? There's life guides you can look at that would do that. Okay? It is a tax shelter. It is a tax shelter. So you can use it for both personal and business and get the tax liability. It's a level premium. It have the whole life term have level premium. Okay? There's another policy that is very important that's called a bank-owned life insurance. A BOLI. Bank-owned life insurance, a type of life insurance bought by a bank as a tax shelter to leverage tax-free savings provision to fund employee benefits. Yeah? So there's other things that you can get with that as a homeowner, as a business owner, as a business owner that can work for you. Additionally, its annual renewal term, you have a right to. The annual renewal term, you have a right to, as long as that business remain operational. Okay? It has to remain in business. Okay? Bearing in mind that only a permanent policy or a whole life policy has a disability element. A term insurance does not have a disability element. So in layman terms, what I'm saying is a term insurance, if you within the term and you expire or die, it will pay out. But if you're alive and something happens, you are not covered. Okay? You are not covered. If you become disabled, you must die for a term policy to pay out. Now, I have another question from Facebook. Says, what can a Keyman Insurance do to help protect business financially if an individual who is critical to the company dies or becomes partially disabled? Great question. That's very important to consider. Understanding statistics. Statistics as of February 12th, 2022 shows that 71% of small businesses, 71% of small businesses rely on one person or two people to oversee the day-to-day operation of the business. So a key man policy is necessary when executing a buy or sell agreement to transfer ownership of the business if one of the partner dies. So if you put things in place, put it in place all the way. Because I'm sure when you invest with someone, you want to make sure that your family gets your share should anything happen. But can the business sustain your share, or do the business have to close down to be liquidated to cover your share? What do you want your share to be? Do you want to be in a position to dictate the amount that's being paid out as your share? Well, there's two ways to find that out. One, when you're executing a buying or selling agreement or transfer of ownership of the business, did you make provisions for your family in that agreement? Is there an agreement that says if one person becomes critically ill within a business organization who makes significant contribution to the revenue? Significant contribution to the revenue. Well, what is significant? The guys that open the door, clean the building before they open for business. The guy that does the marketing for the business, that brings the business in. Just to name a few. Okay? So, the benefactor of the business becomes the business that's receiving the money. And of that amount of money, they will pay out a sum to your family. Of course, that sum is what you agree to. Leaving an amount, I hope you would do, leaving an amount that would cover the other elements of the business. Getting someone to replace you, or getting the business to move on without you. If you become disabled, and you have a permanent policy only, disabled, you will be paid up to 90% of the policy. 90%. It cannot exceed $1.5 million. You could take it a lump sum, you could take it monthly. Distributions from the policy. So to answer your question, yes. A permanent policy is a more advantageous policy than a term policy because it has more benefits, especially in today's world. The next question is, coming from Facebook, business owners or partners, members, I think I got it here. Contribution significant to the business revenue profitability. Okay, the person would like to know if business owners and partners, members of the executive leadership team, and top salespeople are able to get this policy. Yes. in the passing away or becoming disabled, then the policy could provide funds for the continued day-to-day operations and clearing up outstanding debt or recruiting a suitable person for replacement into the company. These things can be achieved by having a key person policy. Okay? The next question, oh, Facebook is lighting me up. I'll take the last question and then we'll move on into debt management. How much keyman policy is necessary? Okay. There is no precise formula to determine how much keyman policy is necessary. There's no precise formula. So don't let nobody fool you. There's no precise formula. What there is a simple factor that is taken in consideration as to how many people has to be covered and what you would like to be covered. How many people and what? It's very important that we know how many people. It's very important that we know what is being covered. Okay? It's very important that we have the structure of the business in a precise way that we can look and see how many changes needs to be done, how many hats that person was wearing at the time of their demise. They become disabled or died. So it's very important that we think about that and look at that in putting the package together, because we have to make sure that the business is totally covered and we have sufficient coverage. Listen to me, guys. We have sufficient coverage that would allow us the ability to do more and keep the business open. For my friends that likes to talk about living benefits, it do have living benefits attached to it, and you're able to live and build or be taken care of in going forward. So before we go into our debt management element of the program, I would like to say to all our listeners, thank you for listening and joining with us every Tuesday from 7 to 9 p.m. right here, live on Facebook, Block Talk Radio, the Black Billionaires Club. We're here. Give us a call. 855-411-0424. If you have any questions, concerns, or you need a policy, whether it's a whole life or a term policy, give me a call on 855-411-0424. And every Tuesday from 7 to 9, you can either join us on Facebook Live, or you can dial 347-857-1311. You could dial in live and listen to us on the air. Thank you very much. For those of you who would like to get in touch with me, Again, I'll give you my contact number. It's 855 411 0424. You can
Services LLC for all of your financial needs. We are a licensed brokerage with years of experience in the financial industry. Let's discuss your financial DNA. Saving for college, planning for your retirement, preparing for milestone birthdays, and significant investments such as house, car, or boat. Call Gene at 855 411 0.
okay. So now, as we move into our debt management, I would like us to look at a couple of things. In debt management, I want to cover a few things that's very important to us. We're talking about business and finances. We talk about financial DNA. We talk about the 7 milestones. We have covered our financial education, proper protection of our income and our savings against loss. Now, these are different times, and I am looking for us to really look at debt management in a great, great deal. So let's get into it. Consumer credit. Let's get into consumer credit. Your credit. Your credit. Consumer credit is to purchase goods and services. Is to purchase goods and services. Consumer credit. Okay? Consumer credit is a way for people who spend money on products to get an advance on money required for that objective. The commonmost example of consumer credit is a person using a credit card. Not a debit card, a credit card. The person that uses a credit card to pay for goods or services, then repays it to the credit card company at a future date. Well, this is where we need to look at the reality of consumer credit. And the reality of consumer credit would be at what cost? We all know there's no free lunch. So if we know there's no free lunch, we ask at what cost? Consumer credit and its function is a credit system that allows consumers to borrow money or incur debt to defer payment of the money over time, to defer the amount of money over time. Credit enables consumers to buy goods and assets without having to pay for them in cash at the time of purchase. Okay? That's what the Federal Trade Commission, the U.S. Federal Trade Commission says it's for. So now, consumer debt are broken down into different elements. Now, I don't want people to get confused about consumer debt. Okay? A home loan is not a consumer debt. A home loan is not a consumer debt. Real estate is considered an investment. And if real estate is considered an investment, a mortgage becomes a facility that allows you to acquire the asset. It's not a consumer. With using consumer credit, fees associated with using a consumer credit, whether it's an installment or revolving account, there's fees associated with it. So I don't want people to get confused and says mortgage, my mortgage is consumer credit. It's not. It's an investment. That's why I encourage everyone that has an income to consider giving me a call at 855-411-0424 so we can go over your financial DNA and we will cover your debt. A part of it is your debt management. Okay? Your household consumption of finances, of money, is what we look at and see how we can look at it, how we can structure it for you to pay it out. Credit card debt, very, very important. If you're utilizing more than 30% of your credit card debt, call me. 30% of your credit card debt, you need to call me. That's the biggest consumer credit that's out there. The next one is student loans. We all want a higher education. We all need a higher education. The current president of the United States of America have put some programs in place for student loans. Research them, investigate them, see where you fit, see how you stand, see what you can do, how you can benefit from it. Auto loans. Auto loans. Auto loans currently, interest rate just went up. The feds have just moved interest rate just last week. Okay? You know what that's telling you? When you go and take a loan, what are you going to pay for a car per month in interest on that loan? Okay? A good interest rate currently, good interest rate on a 72-month new car is 3.96 APR. Annual percentage rate is 3.96%. 3.96%. Okay? The auto rate by credit score, and guys, this information is on the internet. If you have a 780 to 850 score, you can get that rate. And as your score go down, the rate get higher. Okay? Now let's look at the medium score. The medium score is 600 to 660. Your interest rate is 5.35%. 5.35% all the way up to 9.77% for an auto loan. Okay? And if your score is between 501 to 600, the low is 9.9% interest rate and the high is 15.91% interest rate. My friends, cost of living is not decreasing. Interest rate is increasing. Inflation is at our doorstep. Okay? We need to look at where we are, where we're going, where we need to be. Okay? Where our financial future is taking us, is leading us. Okay? Now, 1 year ago, a 30-year fixed interest rate with a 700 score was 2.5%. Fixed for 30 years. Unfortunately, a 30-year fixed rate today with someone that have between a 700 and a 719 score, it breaks my heart to even say it's 4.936. 4.9% interest rate. Nearly double 1 year later. This is not rocket science, my friend. This is not rocket science. What I will say to you, don't have a 620 score and go and buy a house because your interest rate is 5.6% on a 30-year fix. Okay? Worse, if you're a 580 score, you can't buy anymore. There's no data for 580. And for those of you who, have some challenges on the credit, I got a bit of bad news for you. You got to start stepping up the numbers. And that is why we're having this segment on consumer debt. We have to look at that. We have to look at payday loans. Some people take payday loans because one of three elements. Either they fail to plan, or they put their living expense so high that their income cannot suffice, and they're not able to meet up with the financial day-to-day living. So they are taking payday loans. Those interest rates are very, very high. How do we adjust from that? Okay? How do we adjust from that? You need to look at your expenses. Okay? You need to look at your income. You need to look at, like we discussed before, what can you do to change your income? You need to look at your student loan, your automobile loan, your credit card and payments, your payday loans, or any other credit alternative or financial products you have. You have to look at banks that are charging you every month to have an account with them. Okay, there's a number of banks that charge nothing, credit unions that charges nothing to have an account. Okay? The things you need to look at also is finance companies. A lot of companies are going to finance companies. The interest rates are high. Okay? If you go to your bank know you, your bank know what you do. When you do higher purchases, okay? Other things like other financial institution use of things that are high in interest rate. What do? It's very, very important that you look at these things. Consider these things when you're making decision to establish credit. Okay? I need you guys to pay keen attention to this because this is what hurting us. This is what hurting us financially. Okay? This is what hurting us financially that has emotional effects on us. So we need to take these things into consideration. Revolving credit. Revolving credit is a form of credit that allows you to borrow money up to a certain amount. Up to a certain amount. There's 4 common forms of credit. 4. Revolving credit is one of them. Charge cards. Well, I know everybody knows what a charge card. This is a form of credit often mistaken to be the same as revolving credit. It's not the same. It is totally not the same. Revolving credit is revolving credit. And a charge card is a charge card. So we need to be sure about that. When you go to Lowe's or you go to Home Depot or one of those companies, and you are Marshalls and Ross and those companies, you get their store card. It's a charge card. It's only to be used at that store or that brand. When you have revolving credit, Visa, MasterCard, American Express, well, no one uses Discover that much. Diner, oh, you could tell my age when I talk about Diner card. Okay? Revolving credit. Then there's installment credit. Installment credit is where you're paying an installment every month. If you don't pay it down, it ain't going down, buddy. You have to look at these things in your consumption. Non-installment and service credit. Those things must be taken into consideration. You have to look at those and see where you are. Don't take it lightly. Okay? So, it brings us to the very next element of credit. And this is where business owners, individuals meet, but does not take into consideration standard unsecured credit. What is a standard unsecured credit? A standard unsecured credit is a credit card that is not secured by anything. That's the one that gets reported to the credit bureau very quickly. And you have to keep your eyes on it. Because you may be paying off the balance or paying down the balance, but it's not reflected on your credit report monthly. That's why we spoke about credit monitoring. To make sure it's accurate reporting. Accurate reporting. Secure credit cards. A secure credit card is designed for people who has no credit. And the loan, the amount of money is secured by an amount. It's secured by an amount to ensure that the creditor does not lose. Whatever you have, it's there for them to recover if you don't pay. Very, very important. Then there is credit card for students. I personally hate it. Because if the student does not work, how will the student repay that credit card? So they're leaving school with debt. Additional debt to the student loan for those who have student loan. Okay? We gotta look at that. We gotta pay keen attention to that. We have to educate our young people. Okay? They say, oh, I can get a credit card. Great. How are you paying for it? When you use it and abuse it, how is it going to be paid for? Okay? Small business and small business credit card. If you have a small business, you want to have a credit card for emergency purchases, to track spending. You'd like to have one. You should have one. I'm a business owner and I have a credit card for my business. Because I can just take the statement and give it to my accountant and he can reconcile my accounts to do my taxes. There are only 6 types. The next one is a store card. A store card. And then you have your charge cards. Okay? So we have to know what we're doing. There are 5 types of credit. There are only 5 types of credit. Trade credit, bank credit, revolving credit, installment credit, and mutual credit. Open and service credit are not generally used, but Wall Street like it to be there. So I will tell you about it. Consumer debt is incurred by an individual, primarily for a personal, family, or household purposes. Okay? Any debt that is not defined in the bankruptcy code as debt incurred by an individual for personal, family, or household reasons are considered non-consumer debt. Non-consumer debt. The IRS, and I want you guys listen to me, the IRS, this is tax time. owing the IRS is considered a consumer debt. No, it generally is not considered a consumer debt. Not. Taxes, including income taxes, are generally not considered consumer debt. Most courts consider taxes to be non-consumer debt, although in some odds it's become no voluntary incurred tax debt for personal, family, or household purposes. We need to call the IRS, make some payment arrangements within your budget, within the guidelines, so that you can settle those debts going forward. Okay? Because it can come back to haunt you in the future. Those debts are very, very, very important to manage. It may take changing your spending habits. It may take some sacrificing of some of your day-to-day activities to do that. But it's worth it in the long run. It's worth it in the long run. I would applaud you to never, ever, ever do whatever it takes, okay, within reason, legally, to not get a consumer debt collection. It hurts your credit. It's there for an extended period of time where future lenders, employers, insurance companies can see it, question it, and or use it against you. Collection debts are debts owed by an individual consumer to a business. These include credit cards, medical debt, unpaid mortgages, loan balances, and so on and so forth. We need to take a look at our credit report and make sure that they are accurately reporting. For the business owners, trade debt is similar kind of debt as a consumer debt, except it's between the retailer, the business person, and the supplier who sell the product, not against your personal credit. So again, I would applaud you to take out a separate account, separate credit cards for the business. That should something happen to the business, you are not personally affected. Your personal credit is not affected should you have to wind up the business. Okay? If you're going to wind down the business and you have a key person policy, it can help in resolving some of the financial burden that you as an individual that possibly personally guaranteed the loan would have. So I need you guys to think about that, consider that. When you're deciding not to pay, you know how some people do, they decide not to pay and they don't want to pay and they think there's an issue and they don't want to pay, it affects your credit for 7 years at minimum. It crashes your credit for 7 years, and your score keeps going down, and it's hard to rebuild. It's hard for another company to trust you with their money, with their assets, because you don't seem to be what they will call a credible person. So I need you guys to also take into consideration, and I'm going to leave you guys on a heavy note for this segment. I'm going to leave you guys on a heavy note. And it's, what are the 5 C's of credit? What are the 5 C's of credit? The 5 C's of credit is character, capability, capital, collateral, and conditions. Character. Capacity. Capital. Collateral and conditions. When we come back after our questions and answer, we will get right into that element of credit building, credit mining, and how we should move forward with our credit. So I will take I got a loaded board here. So I'll take my questions from Facebook. My first question coming from Facebook. Okay, I have to go down a little bit 1 second, because this person is talking about key person policy, and we're on. Okay, I'll entertain the one last key policy person. One last key policy question. Yes, a key person policy does allow for the disability element on the long-term element of the insurance. Yes, it does allow for it. So the key person policy do allow for it, and if it's a whole life or permanent policy, it allows for it. A whole life policy allows for it. Okay? The next question is the loans, consumer loans, education loans, auto loans, personal loans, credit cards, are they types of consumer loans? Yes. Consumer loans are mortgage loans, auto loans, educational loans, personal loans, refinance loan, and credit loans. Okay? Those are the loans that are consumer loans. Those are the ones that hurt your credit going forward. Okay? The next question is pertaining to the IRS. Does the IRS, no, the IRS, owing the IRS is generally handled by the IRS. So I am not an accountant. I'm a financial advisor. and I am applauding you, encouraging you to explore your question for proper answers with an accountant. I cannot give uh, accounting advice as to what the IRS would do or not do. Okay. The next question is a trade question. And to answer your question, it is absolutely true that credits are important to acquire to take the liability of the business off of your personal credit. And I would say this to you. There is many people that utilize personal credit for their business. I am not the one to knock anyone for what they do or choose to do. What I will say is that when you choose to do that, you're choosing to accept the liability of the business should there be a loss in the business. You're personally accepting the liability. The business is its own entity, its own element. It's a second you. And it's not doing you any justice by having that business give you that liability should there be a loss, should something be wrong. Okay? So I need you to take that into consideration when you're thinking about using your personal credit for the business. Okay? So I'll take my final question for this segment is paying back. Okay. You can pay more. Right. Installment loans. Installment loans such as student loan, mortgages, and car loans are installment loans. You can pay those back consistently over time. And it has a principal element. So you pay in principal and interest based on the agreed APR, the annual percent rate that you and the lender agreed to. Okay? So with that being said, we'll have a short commercial break, and then we'll come back and get into our final 30-minute segment. Okay, for some reason the recording is not playing. Okay, so I would say my name is Eugene Bias. I'm your host. I'm on every Tuesday from 7 to 9 p.m. 7 to 9 p.m. every Tuesday, live on Facebook, on Block Talk Radio, on the Billionaire Network, Project Neo, from 7 to 9 every Tuesday Eastern, 7 to 9 Eastern. I can be reached on Facebook, Twitter, to name a few, LinkedIn. I don't remember them all. But you can get a hold of me. You can send me an email at ehbservices@consultant.com. That's ehbservices@consultant.com. Or you could call me directly on 855-411-0424. That's 855-411-0424. This is your friend and financial advisor, here to help you with all your financial needs, to understand your financial DNA, and to accomplish the goals of your 7 milestone. The 7 milestone in building a financial legacy. So at this time, without further ado, we're going to go into what are the different types of credit. There are 3 types of credit: revolving, installment, and open credit. Revolving, installment, and open credit. With those 3 types of credit being there, we need to understand where we are, what we're doing, and how we're moving it forward. It's very simple. It's very simple. While debt uses property, while secured debt uses property as collateral to support the loan, unsecured debt has no attachment to it. Unsecured has no attachment. Okay? So there's no recourse if you don't pay for unsecured debt. Okay? There is 6 known misconceptions about secured versus unsecured debt. 6 misconceptions. Okay? 6 misconceptions. Understanding the value of secured debt. Okay? Understanding the value of secured debt. No one these days understand the value of secured debt. And it's very important that you understand the value of secured debt. Because if you deposit $1,000 into an account, all you're going to have is $1,000 credit. You're not going to deposit $1,000 into the account and get $10,000 debt credit. It's not going to happen. Okay? Another misconception is between prepaid and secure. They're not the same. A secure debt is you put down a deposit to open a credit line. However, as you make purchases, that deposit is not touched. The deposit is not touched. Instead, you receive a bill to pay the balance or a minimum amount at the end of the month. The only time the deposit is used is if you default on the account and fail to pay back what you owe. So your deposit is secured. You pay it back every month. There's no reason for them to touch your deposit. They lend you equal to what you deposit. So you deposit $1,000, they lend you $1,000. You pay back the $1,000, you get back your $1,000. It's a way to build credit. With a prepaid credit card, you deposit money into an account. Then the money is used each time you make a purchase. The transaction is deducted from the credit balance. There is no bill at the end of the month. No bill. Whatever you pay, is that you have to use. You don't pay, you have nothing to use. Very important to understand the difference between the two. A secured credit card and a prepaid credit card, they're not the same. Then there's the hard one. The hard one. Saving secured collateral during bankruptcy. If you have secure collateral and you don't want to lose it during bankruptcy, you have a few avenues you can take. One, Chapter 13 bankruptcy does not liquidate your asset. Chapter 13 does not liquidate. The court assigns you to a repayment schedule that is administered by the bankruptcy trustee. So you don't have to lose your house. You don't have to lose your car. You repay it through a bankruptcy trustee. On this plan, you have to at least make a portion of the debt you owe. You got to repay a portion of the debt you owe. Then once you complete paying, your remaining balance is discharged in bankruptcy. I don't like to go the bankruptcy route. I discourage the bankruptcy route unless it's very necessary. Because the bankruptcy route stays on your credit for 5 to 7 years. And when you do bankruptcy, you are at a disadvantage in acquiring credit in the future. Disadvantage. If you file Chapter 7 bankruptcy, assets, all your assets are typically liquidated. They sell it. The funds from the sale are used to repay your lenders and creditors. Your lenders and creditors get paid in a Chapter 7 bankruptcy. However, assets needed for basic necessity like a home or a car can be exempt up to a certain value. It can be exempt up to a certain value. The exemption is set by the state you live in. So you must check it up with a licensed attorney to see what you're able to keep and what has to be liquidated before considering Chapter 7. So these misconceptions need to be addressed. You need to be aware of what's going on, how it's happening, and how you can minimize based on your lack of knowledge. So I need everyone to understand that we are in a different time. We are faced with different expenses, expenditure, inflation, okay? Now, there's a number of people talk about borrowing. Borrowing, there are only two ways to borrow. There's only two ways to borrow. And I'm sorry to break everyone's feelings, hurt anyone's heart. There's only two ways you could borrow. It's either a secured loan that has a collateral, or an unsecured loan that does not have a collateral. A collateral loan is an easier loan because the lender is aware that there's something they're holding on to that they're able to use in the future. An unsecured loan is more of a risky loan. The lender has nothing to seize, nothing to sell to recoup. So their guidelines tend to be more stringent than a secure loan. Do they provide the same credit rating across the board? A loan is a loan is a loan, except for collateral loans versus unsecured loans. They are both loans. Both need to be repaid, so they're equally scored on your credit report. Okay? So you have to take a stock of your expenditure and look and see what your revolving credit versus installment credit, your secured and your unsecured loans will do for you and your credit. And that's how we make the determination of which one we pay off first. Okay? Credit cards are unsecured loans. Personal loans are unsecured loans. Medical bills are unsecured loans. Student loans are unsecured loans. Anything that is secured by any or all types of assets are secured debt. Common examples of those are mortgages. It's secured by the property. Cars, automobile, motorcycles, boats, and RVs. Those loans are secured loans. Home equity line of credit. Home equity line of credit. Home equity loans, they're all secured loans. They're easier to get because the lender has security that they can take, repossess, and resell. So, in looking at it, you have a number of things to consider. Generally, there is no risk of loss of collateral if the loan isn't repaid. The lender cannot directly seize the collateral if you default on the loan. It's unsecured. Unsecured loans are flexible. These loans can generally be used for a wide range of purposes. The application process may be quicker since there's no appraisal of collateral. The application process for unsecured is generally less involved. So it's more credit and income based, is less involved. Unsecured credit is widely available in various forms. Credit cards, personal loan, student loan, medical loan are all examples of unsecured loans. Those are the pros. Now let's give you the con. Unsecured loans may be harder to obtain. Unsecured loans may be harder to obtain because of the risk. The lender is likely to have stricter credit requirements for unsecured loans than secured loans. Another con, unsecured loans always carry highest interest rate. Unsecured loan interest rate is from 15 to 24% on a credit card. Unsecured loan rates on a mortgage, if it's unsecured to a mortgage, to a property, starts at 3%. Lower credit limits you get for unsecured loan. Missed payment can negatively impact your credit score. Negatively impact your credit score. I will tell you this. If you have spotty credit history or low credit score, it's a failure in the real world of getting credit, of achieving credit. If you don't have trade lines, you cannot buy a property. You need 3 or more trade lines. 2 to 3 trade lines or more for the minimum of 2 years. So I will tell you, that trade lines are very important. A secured loan generally is easier to get. Will repossess in a failed payment. Costs for a secure loan is generally lower because the risk of exposure to loss is lower. A secured loan has tax benefits. A secured loan has tax benefits, such as your mortgage. Borrowers can take advantage and deduct the interest from the mortgage. The cons of a secured loan: there's a risk of losing the collateral. You're taking the risk. You don't pay, they will take the collateral. Secure loans may require additional insurance coverage on the collateral. They want to be a named party on the insurance. Okay? That should there be a loss, a fire, theft, accident, total loss, the loan still gets paid. For those of you who knows, when you have a comprehensive insurance policy, they ask you, do you have a lien holder? The reason why they want a lien holder, or you buy a car and you have a payment and they tell you they have to be named on the insurance policy as a lien holder because they want to be compensated should anything happen to their car, should there be a total loss. Loan users are less flexible. That's the con. They're less flexible. They give it to you for a specific purpose and they expect it to be used for that purpose and that purpose only. So you can't take a mortgage on property X and take all the money and go and buy property Y. That's not why they lend you the money. Same with car. The bottom line: unsecured and secured debt both involve a promise to pay, a promissory note. But one carries significantly more substantial penalty if the promise isn't fulfilled. You may be able to get more credit by using unsecured credit, and the cost may be less as well. But using secured credit, but unsecured credit also has some advantages. It is important to fully understand the difference between unsecured credit and secured credit before taking out a loan. Understanding how they differ and the pros and cons of each can guide your judgment into making financial decisions, giving you a better chance of achieving your financial goals. As a financial advisor, I would tell everyone, before you make a decision, you need to look at your credit. You need to see what's on your credit. You need to make sure that what's on your credit is accurate reporting. You need to make sure that you are constantly in agreement month after month with what's being reported on your credit. Equally so, you need to be sure that your credit balances does not exceed, your revolving credit does not exceed 30%, 30. It does not exceed 30% of your high credit, your credit line, the maximum amount. If it does not exceed 30%, you are building credit. Your score will keep getting high month after month. There's no magic to building your credit. It's time-driven, payment on time. Okay? So I need everyone to understand that that is the way forward. Okay? We are running out of time here, and we got 5 minutes, and we run out of time. So I'll take 2 questions from Facebook, and then I'll have to say good night. And I see you next Tuesday for more of Let's Learn Money. Okay? Now, the first question is, how does the 5 C's impact me? Well, that's a nice question. I don't know you. Okay? I don't know your character. Your credit report shows your character. That's if you don't have any credit. They take a position based on what's reported. I don't know what your capabilities. I don't know how are you financially. I don't know what your income. I don't know what capital you have. These are the things that we have to look at. These are the things we get out of your financial DNA. I don't know what's your collateral and what condition they're in. You might tell me you have a car. You tell me you have a Mercedes. You have a 2020 Mercedes. It's valued $80,000. But until it goes to the appraiser, I don't know what its value. Or until we get the Kelley Blue Book, we don't know what its value. But yet at the same time, you want me to look at you as an $80,000 collateral. It's not possible. Okay? What if when we go we find out the car is crashed? Do you still value 80,000? But you fail to tell me that. So no, I can't answer that question. How would it impact you? I don't know you. I don't know, and even if I know you as an individual, I don't know the 5 milestones, how you fit into it. I don't know if you have an emergency fund. I don't know what your cash flow is. Okay? I don't know, are you building well? Do you have a life insurance? I don't know those things. Do you have a safe haven? The next question is, and I hope I answered your question. The next question coming from Facebook, my final question for the evening is, okay. All right. The credit that based on length of term is revolving, installment, and open accounts. Okay? You have to look at fixed or indefinite. Fixed or indefinite. Okay? And then you have payment, which is flexible and variable. Ladies and gentlemen, we're out of time here and we must go for more of this continuation this next Tuesday. Right here on Block Talk Radio, Facebook Live. Call me on 1-855-411-0424. 855-411-0424. I thank you for joining me. I thank you for participating. And I look forward to hearing and seeing you in the very, very near future. I'm your host, Eugene Bias, saying thank you, good night, goodbye.